What just happened in New York indicates a nationwide catastrophe is coming, one that will threaten every American household. Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, what just happened in New York is a wake-up call to the nation, and as you're about to see, it's just the beginning. Plus, we have a sponsor for today's show. I'd like to welcome Safe and Green Development back. You can find them on the NASDAQ symbol SGD, and they're a real estate development company that specializes in creating sustainable, efficient spaces using prefabricated modules from wood and steel. And stock is maintaining support on its 200-day moving average, which is a bullish indicator that suggests a potential 43% rally as it looks to retest its 50-day moving average. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline as U.S. factory costs jumped the most in 2 years in New York Fed survey. But this isn't the big part of the story. What we actually see when we dig into the data, the situation in the New York manufacturing sector is looking to outright collapse. But one of the big problems consumers are facing today is rising prices. And we've been talking about how these surveys are indicating that prices are going to go up even more. Well, New York now at the epicenter, suggesting inflation is about to surge higher. A measure of prices paid and received by producers both climbed for a second month in New York Fed's February manufacturing survey. The prices paid index jumped a whopping 11 points to 40.2, the highest in nearly 2 years, indicating a massive increase in prices in the manufacturing sector. But it's not just on the input side. They're pushing this to their customers, noting that prices paid also went up. The problem is we're going to likely see a lot of things start to sit on the shelves, because one thing we've noted is that consumers cannot absorb these higher prices. But the evidence is clear that inflation is going to go higher in New York, again at the epicenter. As we look to this chart of the current prices paid diffusion index for New York, that in blue, against the U.S. consumer price index, that one in red on a year-over-year rate of change. And I want you to see that what happens in New York spreads quickly to the rest of the country. Let's go back to 2003, and what do we see? The current prices paid right here starts to jump. You see that blue line shooting straight up, and what happens to the broad consumer price index? Well, after it slowed down, it took off into 2004. We see that relationship once again right around late 2006 into early 2007. Here you can see current prices paid look like they bottom and then they shoot higher, and that takes inflation right up with it. It happens again in 2010 when we're facing a double-dip recession after the global financial crisis. We see the prices paid go higher, and that means inflation follows. And now let's move forward to 2016. What do we see? A long trend of prices paid rising, and that backfeeds right into the consumer price index. It obviously shows up after the pandemic when prices surged higher. And look at now, you can very clearly see the blue line shooting higher, suggesting that with a lag, we're going to see consumer prices jump, and in a big way. And for the broad U.S. economy, again, this is the worst case scenario. What it's suggesting is an all-out nightmare for the U.S. economy. And the factory data falls higher than expected consumer prices in January, and may be another signal that encourages the Federal Reserve to delay interest rate cuts amid concern about a rebound in inflation. Now, one thing we know about the Fed is they only care about inflation when they want to care about it, meaning if they don't want to cut rates and inflation is rising, they're going to use inflation as a crutch, as an excuse to say, look, we can't lower policy rates, because we know throughout history the Fed does cut into rising inflation. But another issue is Trump's trade plans are adding to the uncertainty, and perhaps a factor of what we're seeing in the manufacturing sector, as I'll show you here in a bit, with the new 10% tariff on China imports taking effect this month, and a slew of others do over the coming weeks, suggesting that prices could go even higher than what were suggested by the New York Manufacturing Survey. But let's turn to this chart, where we can once again conclusively prove that the Fed only cares about inflation when it's convenient to their agenda. Here we can go back to the late 1980s. We can see the Fed cuts rates in 1998, and what happens? Inflation moving clearly higher. How about right around 2000? The Fed's aggressively cutting, but what about inflation? It still runs hot until we're well into the dot-com bubble. How about right around 2007? The Fed's cutting rates aggressively, and inflation is shooting clearly higher. Even going into the pandemic, the Fed cuts rates, inflation shoots up, and that doesn't change their opinion. But this time it suggests the Fed's about to go on pause as inflation's going higher. We're going to look at what the Fed has to say here in a little bit, but there's one chart I want you to see, and that is of our sponsor for today's show, Safe and Green. Again, you can find them on the NASDAQ under the symbol SGD. And again, they're holding here support right at their 200-day moving average. You see very clearly right here. And when a stock does this, it sets up another move. Now, in a downtrend, a stock tends to touch the bottom side of its 50-day moving average. If it does that and rallies up to $2.04, you're looking at a potential 43% return. Again, stay tuned to the end of the show or check out the pinned comment or description for more information. Since Trump's election win, some businesses and customers have sought to get ahead of potential tariffs by bringing purchases forward. Now, you may remember in a past show I said when we were looking at the factory data, it looked like there was a lot of inventory building, and it makes perfect sense because when we look at the recent retail sales data, it says demand's going down. When we listen to what consumers are saying, they're telling us prices are too high and they can't afford them, yet for some reason there's all this demand at the manufacturing level, and it starts to make sense because if you can build it now before prices go up, well, that means you can charge more for your current inventory and increase your margins. And that may help explain the February jump in factory prices. Sure enough, it makes perfect sense. The factories are front running the tariffs. And here we can see right from the New York Fed that yes, prices increase, but there's a sacrifice. And we mentioned this, that just because prices and activity goes up doesn't mean demand for workers go up. And sure enough, what do we see? Worst case scenario, prices rising, and the index for the number of employees fell minus 3.6, suggesting employment levels move somewhat lower, or that manufacturers are laying off and even making a situation worse, while the average work week declined minus 1.2. And while the data suggests it's virtually flat, what it still means is those who do have their jobs saw their hours getting cut. And what this is setting up is an absolute nightmare scenario that's going to spread all across the country. Epicenter again right in New York. You're seeing this, my friends, in real time. Let's take a look at what's coming for the country as we now look at the consumer price index, still in red, against continued unemployment claims in blue. Because when you get periods where prices are rising and you start to see people lose their job with little opportunity in the labor market to find another one, well, you go right into a recession, because what that creates is an environment of stagflation. And yes, you do see rising prices, you do see rising unemployment until the recession hits and everything comes crumbling down. You see that happen again in the late 1990s. Inflation's rising, and at first you can see very clearly the economy can absorb it. The labor market says, look, this isn't an issue, until it becomes a major issue that sends us right into a stagflationary recession. It happens again going into the global financial crisis again, 2006, inflation surging higher. At first, the labor market and the economy say, hey, we got this. And then all of a sudden they don't. Stagflation kicks in. Economy goes right into a financial crisis. And now, very clearly, based on what we're seeing from the New York Fed manufacturing survey, inflation likely to head higher. And based also on their data, unemployment likely to head higher, suggesting that this nation is headed right into a stagflationary recession. This is very dangerous, one that's going to impact every American household. And here's when we talk about New York has fallen, at least the future expectations are plunging as firms expect conditions to improve in the months ahead, mainly because, well, they're building inventory that they're hoping to build at a lower price and sell at a much higher price. But going forward, their optimism declined notably. The index for future business activity fell a whopping 15 points to 22.2. Capital spending plans even remained soft. Supply availability is expected to contract somewhat over the next 6 months, suggesting that New York manufacturing activity looking to plunge in the months to come. I'll show you a chart on that here in a moment, but let's talk about why optimism is falling. It's because demand is going down. When we take a look at real retail sales, as shown in blue on a year-over-year rate of change against the consumer price index still in red, what you can see is when you go into a period of stagflation, yes, the consumer price index rises, but look what happens to retail sales. It goes down right into that recession. You see stagflation hits a little bit around 2005. You see a big jump in inflation and a matching slowdown in retail sales. The problem is, even though inflation dropped around 2006, it didn't actually help the economy. The damage was already done. Retail sales continued to fall. Inflation surged higher. Again, stagflation right into a financial crisis. And let's look where we're at now. What do we see? Inflation expected to head significantly higher. Consumers were front running the tariffs at the end of the year, and now their demand has dropped off, suggesting retail sales likely to fall. That means very clearly we're headed right into a major recession here. Stagflation about to take hold. And let's talk about, again, New York Fed. We talk about how the economy is falling. Look at the expectations of new orders 6 months ahead. You can see very clearly on this chart they're plunging, but current orders are up. And again, why are they doing this? They want to build as much as they can now at current prices because they're going to mark them up and say, look, it's not our fault that there's tariffs. It has nothing to do with us. And they're hoping to grab that extra margin. But if you think the Fed's going to do anything, well, good luck with that, because Fed's Waller favors pausing rate cuts until inflation bump fades. Now, what I want you to see and what we talk about, how the Fed eventually reacts to the data. Now, they want you to believe that they're looking at the economy, they're forward looking, suggesting that they see what's coming and they're basing policy on what the trends are. In reality, they completely look in the rearview mirror. If this wintertime lull in progress is temporary, as it was last year, then further policy easing will be appropriate. But until that is clear, meaning until we actually see the data validate it, I favor holding the policy rate steady. Again, cannot look forward. We only look backwards when it comes to making monetary policy. You wonder why we go into these stagflationary recessions and then the Fed starts cutting rates and we still have recession. It's because monetary policy does not work. And Fed's Harker agrees, saying favors holding rates as policy is still restrictive. In the last decade, CPI inflation January surprised on the upside 9 out of 10 times. So again, you think, here's the data they're looking at, but nope. My conjecture is that seasonal adjustments are struggling to keep up with a fast-changing economy, and we need to parse the underlying trends from the month-to-month noise, suggesting we need to wait, we need to be on pause here, so we can likely look forward and say, what is the Fed going to do about the economy? What are they going to do to help the average American? Well, they're going to do nothing but sit there and wait until the data confirms that it's far too late. And you can see now why what's going on in New York is so critical for the country, because what it's suggesting is we're heading into stagflation, and that, my friends, is going to impact every American household. But that's not the only thing, because I've warned you that the big money was selling, and now the proof is in. You're about to see an undeniable sign that the market's shifting. Let's take a look, because the Bank of America survey shows that investors haven't been this risk on, well, since 2010. And fund managers' cash levels fell to the lowest since 2010, while 34% of participants said they expect world equities to be their best performing asset in 2025. And so why does it matter that you see cash levels for fund managers at low levels, indicating that perhaps the big rally in stocks is over? Because once everyone has bought, well, usually prices change. Remember, we talk about how retail is the only remaining buyer. Well, investors are long stocks and short everything else, as according to leading strategist Michael Hartnett. The bullishness was underpinned by expectations of robust economic growth and lower U.S. interest rates. Well, what do we see from New York Fed? It's saying stagflation is coming. And my friends, that is not bullish for stocks at all. That's something, well, hedge funds know, but retail investors don't. And watch what hedge funds do and not what retail says. And a strong signal of stock market downside risk is when hedge funds are going short, yet retail money is still pouring in. And that's the case today. The retail investors are buying like crazy. And we looked at some of that recent data from Goldman. And what we see here is that analysts continue to move the bar higher. They're telling these companies, look, we're going to make it difficult for you to hit an earnings beat, and then we're going to punish you if things go wrong. And sure enough, we see that as companies that miss are punished and companies that beat aren't rewarded, as we now look for another strong earnings season, as S&P 500 aggregate Q4 profits grew by 12% year over year, compared with a consensus it's 8%. But the problem is, going forward, well, that's not likely to be sustained. Because looking ahead, Goldman's 2025 S&P 500 EPS forecast is for 11% year-over-year growth, which is roughly 1% below the top-down and bottom-up consensus estimates. Now, here's the problem. The companies are going to likely miss that. Remember, I told you Wall Street is a position they're selling here. They're out of this market. They're handing it over to retail. And one of the ways they do that is they set the bar high from their analysts. And that means when the companies don't hit, stock prices go down. But one stock we think is poised to grow, and that is the stock for a sponsor of the show, Safe and Green Development. You can find them on the NASDAQ under the symbol SGD, and their stock is holding support on its 200-day moving average, suggesting a potential 43% rally to retest its 50-day moving average. This is one you don't want to miss. Again, check out all the information in the pinned comment and description below. Let's take a look at what's going on with Safe and Green, because they're making waves, and in a big way. as they're a real estate development company that specializes in creating sustainable and efficient spaces using prefabricated modules made from wood and steel. And Safe and Green, established back in 2021, focuses on developing eco-friendly single and multifamily projects using prefabricated modules made from wood and steel. Its subsidiary Majestic World Holdings has created a real estate AI platform to decentralize the marketplace and integrate various stakeholders. Another subsidiary, Myvonia Innovations, offers an AI-powered personal assistant to help individuals and businesses manage tasks and improve productivity. And they had just announced the first 5 homes from a Sugar Phase 1 development are nearing completion and listed for sale, addressing regional housing affordability issues. The company employs a multi-agent strategy and plans to leverage partnerships for mortgage services and down payment assistance to enhance sales margins. And they recently closed 22 lots in South Texas for $440,000 and secured a loan of approximately $1 million to commence construction on 7 new homes in a Sugar Phase residential development project. The company aims to enhance affordable housing availability in the region, with plans to have a total of 13 homes under construction by the first quarter of 2025 and a goal of completing 55 homes by end of year. And they've also announced a resolution of intercompany financial obligations with Safe and Green Holdings involving the forgiveness of debts and transfer of shares, which aims to clean up its balance sheet and reduce potential future dilution. And on top of that, their subsidiary LV Peninsula Holdings has entered a $6.575 million purchase agreement with Light Development for Largo Vista property, with closing expected by February 12th of 2025. While the company aims to enhance shareholder value through strategic real estate projects and innovative technologies. And here recently, they announced that all 5 homes from the first phase of their sugar joint venture with Milk and Honey are under contract, with expected closing around April 11th of this year. The company plans to begin construction on the next set of 7 homes by Q2 2025, aiming to complete a total of 55 homes this year. And you can see, my friends, this is the catalyst that is looking to send their stock price higher, looking for a reconfirmation against this 50-day moving average. And here you can clearly see it's holding support on its 200-day moving average. That's that tan line running across the horizon. You can see the 21-day moving average coming down, and this is setting up for a move higher. Again, a retest of $2.04. That's the 50-day moving average, which represents a potential 43% move for Safe and Green. Again, you can find them on the NASDAQ under the symbol SGD. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.